Cross. Peter is a former governor of the New York Stock Exchange and a market analyst with CNBC, and he is semi-retired at this point as well. Peter, I would like to start off with a metaphor, or some people say a metaphor, this morning, and see if you were on board with this. The stock market is a bunch of teenage girls. It reacts to every single rumor in a drama-filled, oh, what are we going to do? Over and over and over. Are you on board with that?
You know what, Richard? I never heard that metaphor before, or metaphor. But I have to say that that's exactly the way to describe the market right now is, I mean, it's like going to a Taylor Swift concert. You know, the opening act was, January to February, and then February 15th, Taylor got on stage, and then all hell broke loose. So, yeah, I mean, it's when you're in a market like this, it's very tough having conversations with people because people are, thinking of a knee-jerk reaction. Should I get out or should I get in? Did I miss something? But the reality is, if you're an investor, generally you're a more longer-term investor, and you have to just ride out the waves like this, the periods where, what we're in right now. And, I've been through dozens of them, and I don't think there's going to be, it's never going to change. The markets react. Sometimes it reacts stupidly, and, you just have to be prepared.
So the advice that long-term investors have always given is don't try to time the market. You can't do it. It can't be done. You can make smart decisions in terms of getting in or buying when the market's down or things like that. But if you try to time the market, you're not going to win long term. So for the people that are living and dying, looking at their retirement account statements in this period of volatility, what would you say to them?
Well, I would say, number one, go watch General Hospital at 3:00 Eastern Standard Time on Channel ABC, because really, if you think about it, there'll be days where you'll think you're, the richest man on earth, and then sometimes you're going to think you're the poorest person on earth when you're looking at your portfolio. But the reality is, you're not taking all of that money. No, very, very few investors are taking all of their money out of their account right now. So, you're looking at the long term. You have to remember that over the course of your investment experience, you've made money. So you may have put $1 million in your account over your lifetime, and now you have $3.5 million. So if your portfolio goes down 5% because of the volatility, you're still up a tremendous amount of money. I mean, granted, inflation has taken some part of that out, but generally at a 7.5% to 10% clip, everyone is making money, so you're up. Why would you fret about, being down 5% for the last 6 weeks or whatever the case may be? You're up long term. Your bigger picture is you're still on the plus side. So to me, that's the important thing, is knowing that, my investments over time have been about X dollars, but because of the returns and the way the markets react and have reacted over the last 2 or 3 decades, I'm up significantly, and a 5% pullback, it's not the best thing in the world for you, because obviously it's a mental thing. But the reality is, when you look at on paper what you're worth a lot more than you were when you started. So to me, it's just keeping the bigger picture in focus. And all right, you can talk about the market because everyone is talking about it. But the reality is, every investor, if they've started at some point in the last 20 years, they're all up, unless you're just like, I don't even know what you'd be invested in if you were down, but you're up pretty much. Everyone is. So, just keep that in mind. You're still on the plus side of the ledger.
I've got a buddy who was having he's a banker, and he was having a conversation with his mom, and his mom was like, "Oh, I'm really worried about the market. It's down a good bit the last few days." And he said, "Mom, what do you need the money for right now?"
Yeah.
She said, I don't need the money. She's like, I'm fine on a week to week, month to month basis. I'm just kind of. He goes, "Well, are you ready to sell all your stocks? Are you ready to sell out of everything?" She goes, "No, of course not." He goes, "Then you didn't lose anything. Quit worrying about it."
It's just paper. I mean, right now it's just paper. And I know that's an easy thing for people to say, and I know it's a lot harder for people to do is remember that you're not taking all that money at this point. You might take some, you want to buy a boat, or maybe you want to buy a vacation house or something like that. But if you're going to buy a vacation house and you're down 5%, you're up somewhere because you're not, you have the money to buy that vacation house. All right. So it's a little bit less. All right. It's not the greatest thing, but the reality is everyone is going to be okay. And then one other thing, Richard, and I brought this up on a number of different shows, is that when you have a sell-off in the market the way we've had over the last, 3 weeks, let's say, just give it that space, investors have raised cash. You sell at the high of the market. That's a profit. That's money. That's cash. That's sitting on the sidelines. So whenever we have a sell-off like this, generally there's a lot of cash that moves out of stocks and out of bonds as well, and moves into maybe a money market for a short period of time. The reality is there's trillions of dollars sitting on the sidelines waiting for the opportunity to start reinvesting that money. So, you can have a sell-off, you can have these multiple sell-offs, unless there is a significant financial event or a depression, that develops. That money goes back into the market at some point. So there are price points where the market will start stabilizing, and I think we're at it. I think we've already hit it. So the money's moving back into equities and moving back into bonds. So I think you just got to ride this stuff out, because it's not disappearing. It's just going to another place.
I thought there was an interesting thing, and we're not going to focus on individual stocks very often, but Tesla is kind of a different animal with the like the bright lights that just flash around Elon Musk whenever he opens his mouth. So they reported a 20% drop in auto revenue first quarter, and that was reported yesterday. And yet Elon Musk also said that in May he's going to slide back into a bigger role with Tesla. He's going to step at least partly away from Doge, and shares were up 7.5% overnight. It's kind of hard to make those two things make sense together. Missed earnings down, but the head guy's coming back and the stock goes up.
Well, you know what it is with Elon Musk? He's in a different space as far as business leaders. I mean, there's a contingent of investors that just live and die by every word that he says, and the guy is brilliant. Let's not, whatever anybody thinks about what he's doing with Doge, what I think is great. The guy is brilliant. I mean, he's launched rocket ships. He's building. He's the thinker that we haven't had in this country in a long time. And I think a lot of people invest based on his track record, number one. If you look at Tesla and you invested when they first came out, you'd be doing very, very well. But it's a certain group of investors that live and die on his word. And I think that's what you see. And a lot of times, there are computer models that trade stocks, all over the place. And they generally guide stocks, whatever. So if there's positive commentary about Elon Musk anywhere in the world, generally computer models will go and buy the stock because they're anticipating a run on the upside. Well, they happen to be the ones that are making the stock run up. So, there's those two things. There's that cult of Elon Musk, which is significant. And then
we'll be right back. We got more with Peter Costa on the other side of this, talking stocks and the market. Wednesday morning, thanks for being with us. This is Mornings with Richard Cross on SuperTalk Mississippi. Wherever you're listening, however you're listening, we appreciate you being on board, and we invite you to join the conversation. You can do that on the C Spire text line at 601-879-4395. The best teams know how to get even better. That's why C Spire constantly enhances their wireless, fiber internet, and business solutions for you. Visit them online at cspire.com today. C Spire, inspired by you. Peter Costa is my guest. It's also my friend, former market analyst with CNBC, former governor with the New York Stock Exchange. He is joining us this morning. I want to play something for you in a second. It has to do with conversation about the recession, or a recession, from a Fortune 100 CEO. But before that, we got a message. Somebody was just talking about their investment strategy, and it was talking about mutual funds and kind of the safety there, and he'll ride a single stock up and down, and then when it's up, he'll roll that money into a mutual fund. There's a lot of talk these days about ETFs, I think more than maybe there used to be, electronically traded funds. What's the difference between a mutual fund, which has always been considered to be kind of a safe long-term investment instrument, and an electronically traded fund or an ETF?
Well, with an ETF, you have the ability to get in and get out during the trading day, which mutual funds are to get out. It's usually priced on the close. So what happens with an ETF is if you're, an active trader, and I mean, trading ETFs to me is a little bit of I don't know. I mean, you could trade the triple Qs. You could trade a lot of different vehicles if you want market performance. But generally, an ETF will focus on a certain group of stocks or a certain fundamental approach to investing, like an inflation type fund, or and you can buy it and sell it generally during the trading day. I mean, the liquidity is not super great in some of these ETFs, but there are ETFs that can trade 25 and 30 million shares a day. So, but the idea is to get in and get out, periodically during the day. And what the ETF does is when there's a sale or when there's a purchase, the computer models that are attached to these ETFs buy the underlying securities or sell the underlying securities. So you can watch the movement in an ETF, and you can watch the portfolio that's inside of it react. They're almost, hand in hand. So it's a good way to cheaply invest in a group of stocks, where a mutual fund, I think, has a little bit higher expense ratio. Most ETFs' expense ratio is very, very low. So that helps too. I mean, not that most of us really even are concerned about the expense ratio, but it is, a factor. One of the things, though, is that, as far as tax-wise, it becomes a complicated situation. And at the end of the year, if you traded an ETF all year long, there could be significant tax consequences. But for the most people, it's an easy way to get in and get out in a strategy that they like. Instead of buying, Dow Chemical, you buy an ETF that has Dow as one of its components, and you get the benefit of Dow and all the other components, doing well or not doing well. It all depends on your strategy. Me personally, I originally didn't like ETFs because I said, if you're going to do the research on a particular stock, buy the stock, But I understand why investors do use it, because, they can have an underlying stock that they really like, and that stock might be up 20% for the quarter, but the rest of the group is only up 5%. The ETF is only going to be up a certain, it's not going to be the 20%. It's going to be averaged somewhere in between. So,
And an ETF is generally supposed to be reflective of the S&P 500, right? So basically what the S&P 500 is doing, if you're buying into an ETF, it should generally track along those lines.
It all depends, though. Some ETFs are, there are ETFs that do the opposite. They're a short ETF where they react to the market. So yeah, I mean, it's a little more complicated, and they're not as liquid. But there are ETFs that will do the opposite of what the market's doing. So if the market's going down, that ETF is short, it'll be going up. So there are certain, it all depends on which ETFs you're in. Most of them tend to try to be around what the S&P 500 is. They may not have all 500 stocks in there, but they might have a select group, the Magnificent Seven, for instance, and then maybe 10 other tech stocks. But generally, that's what they are. It's a cheaper way of investing, and it's liquid for the most part, and it's easy to go in and go out. And if you don't like the idea in the afternoon, you can sell it. And I think that's an advantage.
All right, I want to play this from you. Mike Wirth, the CEO of Chevron, was on CNBC yesterday. You have said in the past that you think that a recession is a very real possibility. You've had people at Goldman and JP Morgan and other Wall Street firms that have said a recession is coming at some point. Some of those people are just labeled as doomsdayers, and they're going to say something negative. Some are saying, hey, these are smart guys, you should listen to them. You've also got the Secretary of the Treasury, Scott Bessent, saying, no, we don't see the market conditions for a recession. This is what Mike Wirth said yesterday on CNBC.
You don't think we're headed into a recession in your plans at this point?
There's no signs that we see at this point that we're in or close to a recession. There are signs that growth may be slowing. And again, we have to always be prepared for that. But ours is a long cycle business. The capital we put to work in our business isn't there for just a few years. It's typically there for decades. So we really have to take a longer view and not get buffeted too much by short-term market movement.
All right, so is Mike Wirth saying no recession or not a recession that affects our particular business line?
Well, to me, he's more about Chevron, which he's right. I mean, any of the oil companies, their time frame is extraordinarily long as opposed to an Eli Lilly or General Motors. They look at things in 30, 50-year time horizons. So I think that that's what he's looking at, is that he's looking at for his company. They see pullbacks and they see slowdowns in the economy over decades, but it doesn't really impact Chevron, because what they do, and they find an oil field that takes 15 years to extract or at least get the most benefit out of an oil field in 15, 20 years. So their time frame is a lot longer. I'm still in the recessionary camp. I don't see it being a deep one, but I do think that there's a probably better than 50 to 60% possibility of it this year. We could be in a recession and not even know it. And we've been in recessions before. We didn't know it until we got out of it. So that might be the case as well. It's not, we don't have, the problem that to look 6 months out in the economy and the market and everything, one of the main problems is we still have to deal with where are we going with tariffs. And I know that, my thing has always been, you want clarity, which is what the market has been striving for, and having, the issues with President Trump and Jerome Powell, that seems to be resolving itself. So the markets rallied after that. But my other concern is consistency. And that's something a lot of people don't talk about, is that you need consistent economic, in a consistent economic agenda, one that people can invest in and understand that, if they say they're going to have a 20% tariff, they have a 20% tariff, how to invest in it. You know what to do, where to go, what to do, how to set your portfolio, and how to set up your platform for investing for the next 6 months. But
and that's not just for investors, that's for businesses and business owners as well.
I was going to get to that. Businesses have a very hard time for planning because they don't know what, as far as supply. I mean, we still, no matter what anybody says, we're still getting a lot of our supply chain from China, Vietnam, and Malaysia. Tariffs are going to increase the cost. I think they'll probably tone everything down to a certain level. And we won't see 134% tariffs on Chinese products. I think that's done. But the idea is that businesses are investing based on that number. And now, the president said he's going to walk that back a bit. It's the consistency. I think that's to me, that makes it a little scary to invest, because you don't actually know. I mean, you never really know what the future holds, but you kind of have a general idea of what the future looks like in whatever business you're in. This has muddied the waters considerably. So, I think that once you have the consistent message from the White House, consistent, reports. The earnings seem to be doing very well for the first quarter. I don't see that in the second quarter. I see the second quarter is going to be, right now it's cloudy as it is. I think it's probably going to be a rough go for the next probably 3 to 4 months as far as the economy. But if they have some sort of consistent approach, consistent, platform and how they're running everything and how they're going to do their tariffs, I think that'll help a lot. Even if it does cost more money for individuals, understanding that you're going to be, inflation might tick up a tick. And then, you know what, we've gone through it already. And, leveling the plane.
In the long run, maybe we'll be okay. Peter Costa, we're out of time. I thank you so much.
No problem.
We'll talk to you soon. Peter Costa, former governor with the New York Stock Exchange.